for the WPI data this time round. So 4.54 versus our poll of around 4.4%. So it's a little, you'd have to say,
worse than what you thought.
Yeah, a little worse than what we thought. But
some more numbers. Manufacturing has come in at minus 1.73. Fuel price index is down minus 17.7. Food price index is up 0.7%. July WPI inflation has been revised to minus 4% versus an earlier minus 4.05. So that's hardly any revision.
So the September manufacturing inflation is at a decline of 1.73%. So this compares to a 1.92% decline. So like we just mentioned, the pace of contraction has lessened for manufacturing inflation.
I'll just give you the month-on-month numbers. It's onions, which is perhaps the only culprit, rising by 14% month-on-month. Otherwise, it's practically unchanged in terms of food prices. Overall, food articles month-on-month have risen by 0.6%, almost entirely accounted for by onions. The only other item that's showing a bit of an increase month-on-month would be, non-food articles, largely fibers, oil seeds, that variety. But in terms of food, pulses have actually shown a muted number. Pulses in the CPI had shown a very strong increase, but this time the increase is muted to 2.3% month-on-month. But of course, it's already a very high base. And food inflation overall is up 0.6%. All commodities index month-on-month is actually down by 0.06%. And there the culprit really is manufactured products, where again, the month-on-month, the month-on-month actually is not a decline. Month-on-month is an increase of 0.1%. So not terribly bad. And that's largely accounted for by sugar. Sugar has risen 3%. So if you took the non-food manufactured items, we may once again see a fall in prices. All other articles actually have shown a fall in prices. Wood and wood products, cotton textiles are still showing a fall. Cement has shown an increase of 1%, 1.8 to be precise. Iron and steel have shown a 1.1 increase. So it looks like the hard part of falling prices is more or less over. In most of the manufactured products, we don't see too much of a month-on-month fall, except for wood and paper. Otherwise, we're actually seeing most of them largely flat. Heavy ones like chemicals have fallen by about 0.3%, but the rest of the pack, cement, non-metallic products, basic metals, which is again a 10% weight, has actually risen by 0.5%. So looks like the worst of the deflationary impact is over, and maybe we will start getting a slightly smaller deflation in the months to come. But let's toss it to our experts. We are joined by Soumya Ghosh, the Chief Economic Advisor at SBI, and Aditi Nayar, Senior Economist at ICRA. Soumya, are these numbers going to any way change your expectations in terms of monetary policy?
See, I think at 4.54%, it's a number exactly we're expecting at 4.54%. But if I just glance through the numbers, a couple of points which comes up immediately. I think the core inflation has come in at minus 1.93. So that's a number which is better than our expectations. In fact, we were expecting that it could be lower than 2%. So that means if we compare with the last month, which was at minus 1.86, so that means the core inflation is actually now may have bottomed out, the decline, the point which we were just mentioning. So, and if you actually look into the numbers for the second quarter and the margins of the corporates, I think that is also getting reflected over there. Some improvement in the margins is already coming about because of the decline in the input cost. So overall, I think the numbers is bottoming out, and possibly even though it will remain in the deep negative territory at least for the next couple of months, but I think this is an indication that things may be just turning for the better.
Okay. Aditi, wanted your thoughts on the overall number and the manufacturing inflation, which is now at a lesser pace, 1.7% decline versus 1.9% in the previous month.
I think overall the number is pretty much in line what we were penciling in. We had a forecast of minus 4.7%, and I think the food number has come in exactly in line with what we were expecting, and slightly different on the manufacturing number. Setting aside sugar, as Lata had pointed out, I mean, if we look at the rest of the manufactured items, I think one thing we need to keep in mind is that the rupee did depreciate a fair bit on average in September, and perhaps some of the tradable goods prices are reflecting that to some extent. But I would say that the month-on-month increase in cement prices that you pointed out, certainly I would look at that as a positive, because that's largely domestically produced, domestically consumed, and possibly that would be good news for what's happening in terms of the economic recovery. So I would certainly, be happy about that number.
That's a bright number, and Soumya also was pointing out that probably the worst of the deflation is over. As he was saying, core inflation, which is really the manufactured products that Aditi and Ekta were discussing, minus food and like sugar and edible oils, the non-food manufacturing probably has declined less. The deflation is at minus 1.93, as Soumya pointed out, compared to over 2% that we have been seeing for the last several months. Soumya, to take Aditi's point forward, cement, as she points out, is showing a rise in prices. Should we expect a little more in terms of manufacturing pricing power coming, or at least the pressure to cut prices going away? Or do you think we are going to get better numbers purely because of the base effect?
See, I think a large part of the base effect has now been taken into account, so that goes out of the window. So any number which comes from now on is actually reflect the ground realities. And from the point that also, apart from the cement prices, if I remember correctly, the iron and steel prices also were raised some time back. So I think the pricing pressures are slowly coming back into the play, because this was not the case in the first quarter when the corporates were unable to improve the margins. So, but right now what is happening is that the input costs are declining, and that is being reflected in a better corporate margins. And that is already evident for some of the companies, and also if we go by the IIP numbers which came out a few days back. So all in all, I will take a WPI number which is negative, but which shows that the manufacturing sector price increase, as you just pointed out, the deceleration actually goes slower. So from that point of view, the WPI number should be welcomed, and possibly in the next couple of months, you will see that a little bit of pricing power comes into the play, that the WPI declines and possibly goes into the positive territory from December or maybe after that.
Okay. We have Vivek Rajpal of Nomura joining in for a quick call on the rates as well. Vivek, what do you think this number would mean for interest rates, and what you're factoring in on the 10-year as well?
So, on 10-year bonds, we are constructive. Overall on the bond market, we are constructive. We think we are in a consolidation phase. The recent CPI and WPI readings continue to suggest that we are in a stable and lower inflation environment. As far as bond yield trajectory is concerned, I'm expecting 740 on 10-year benchmark within a couple of months.
Oh, that's positive. Thanks a lot for that, Vivek Rajpal. Well, two economists, last two questions. What are you expecting by way of rate cuts, Soumya?
Now, I know you were going to ask this question, but I just came back from Lima, so I can tell you that the global economic conditions remain very weak, and it is across the board now. Not only Asia, Africa has also joined in the bandwagon. And from that fact, I will not rule out further rate cuts in the current fiscal. We can debate on the timings, but I am pretty confident that possibly some sort of accommodation is going to take place in the future.
Okay, when? Is it December? Is it March? Or rather February, I think?
I think December may be in December may be too early, possibly after budget or in the April 2016 policy.
Okay. Aditi?
Nada, I think there's a very low likelihood of further easing in the current fiscal. If the inflation situation seems to be bright post the start of the next fiscal year, and if the pay commission recommendations are on the conservative side, then perhaps we can expect some more easing in the next fiscal year. But I think particularly prior to the budget, it would be very difficult, very low likelihood of further easing.
No, I think your point
there is
February,
which is after
Yeah, I take your point. I mean, there is pay commission, there is possibility of GST. I don't know which way the Bihar elections sway and what happens to the Rajya Sabha's composition on April the 4th. So all that is perhaps to be calculated in inflation. Okay, let's forget the inflation argument. Two more questions on growth. We've got fairly positive growth indicators. IIP was better than expected. The CPI inflation was okay. Almost in line, but again now, as you point out, the WPI deflation is decreasing. Some people are able to price things. Is all this adding up to a better growth story? Soumya, your growth numbers, and will you revise them higher?
We have not yet revised our growth numbers, so we are still at fairly confident that it could be around 7.8% or so. But but regarding the IIP, just wanted to make one point. I think the August IIP number, even though it has come at more than 6%, I think some element of base effect was involved. So I'll be closely following the September IIP number, and I hope that the September IIP number could even be better than August, because there is again a seasonality element involved in September, because October in Diwali month, pre-Diwali month, the IIP shows a jump. So from that point of view, maybe a possible next 1 or 2 months of good IIP numbers could stage the show for a recovery on the IIP number. But as of now, I will take these 6.4% IIP numbers with a sense of positivity.
Okay, and Aditi, your number is also 7.8, GVA or GDP?
Lata, my number is lower. I'm around 7.4% right now. I mean, certainly what we're seeing is a recovery which is not very broad-based, and we're yet to see, it spreading from the few bright spots to a more broad-based recovery. So at this point in time, we're still at 7.4%. Agri economy, rural economy is not looking too positive, and exports, of course, are going to remain a huge drag.
All right, thank you very much, Aditi and Soumya, for joining us. Short point, the inflation number has come in exactly as per expectations, 4.5 compared to Ekta's poll of 4.4, but minus 4.5 compared to Ekta's poll of minus 4.4. But the important point is manufacturing deflation was not as bad as it was in the previous months. It has kind of softened. Prices are falling, but falling a little more slowly. And in some cases, like cement, they're actually rising. So look at the full circle we have turned. For the last 5 years, we have been beating our chest about rising prices. Now we are celebrating the fact that there's at least one product where prices have risen, and that probably indicates a little bit of growth. Over to you, Rima.
Thank you, Ekta and Lata, for taking us through the fine print. Well, the markets are absolutely unchanged. Nifty still at 81.21, and the 10-year bond yield also unchanged.
Stocks because the prices have risen?
No, nothing as of now. So let the markets digest a little bit of an improvement that we've seen in cement prices. On that